The S&P 500 drops 57% in 12 months, losing $10 trillion in market value. Investors with $1 million lost 80% of their wealth, while those with $100,000 lost 95%. But the real crisis wasn't the crash. It was the psychology that turned losses into lifelong debt. Every bad financial decision, from buying crypto to overspending, hides a predictable mental shortcut. This video reveals the 5 psychological traps that led millions to ruin, whether you're rich, poor, or somewhere in between. 25% of U.S. homeowners default on mortgages. $18 trillion in global losses. The 2008 crisis. Proof that human psychology, not math, breaks economies. While banks bailed out, 40% of Americans still mentally account for windfalls as not real money, a bias that costs them $17 in savings for every $100 earned in 2026. Daniel Kahneman's 1979 prospect theory reveals why losses hurt twice as much as gains help. This isn't a flaw, it's evolution. But in finance, it's a disaster. You've heard the phrase loss aversion, but what does it really mean? Imagine you're a trader in 2008, watching your portfolio vanish. Your brain, wired to avoid pain, triggers a fight-or-flight response, not to save money, but to flee it. That's prospect theory in action. Losing $100 feels like a 200-point hit to your happiness. This same mechanism made 70% of investors in 2016 trade emotionally, not rationally, according to a University of Chicago study. The Federal Reserve's 2021 report uncovered another twist. 40% of Americans treat windfalls as play money, segregating savings and bonuses into mental buckets. A $10,000 bonus might fund a car, while $10,000 in savings is left untouched. This is Richard Thaler's 1998 mental accounting in real time, a cognitive trap that costs households billions annually. But here's the kicker. These biases aren't just individual failures, they're systemic. The 2008 crisis wasn't just about bad loans, it was about overconfidence, herd behavior, and confirmation bias. Investors ignored warnings from Robert Shiller, who in 2000 warned of irrational exuberance. The result? A $5 trillion dot-com bubble, then a $18 trillion crash. Your brain, evolved to survive, is now your worst enemy in the markets. The players in this psychological war against your finances aren't just abstract theories. They're real people, real institutions, and real crises that shaped the modern economy. Daniel Kahneman and Amos Tversky's 1979 prospect theory didn't just change economics. It exposed how your brain's ancient survival instincts clash with modern markets. Their work showed that losing $100 feels like a 200-point hit to your happiness, a bias that turned the 2008 crisis into an $18 trillion disaster. Meanwhile, Richard Thaler's 1998 concept of mental accounting revealed why a $10,000 bonus might fund a car while $10,000 in savings is left untouched, because your brain treats them as separate buckets, even though the money is fungible. The 2008 crisis wasn't just about bad loans. It was about overconfidence and herd behavior. A 2016 University of Chicago study found that 70% of investors made emotionally driven decisions, not analytical ones, a fact that helped fuel the collapse. The dot-com bubble, which lost $5 trillion between 1995 and 2000, was no different. Investors chasing winner's curse. Opportunities bid blindly for tech startups with no revenue, blinded by irrational exuberance. Robert Shiller's 2000 research on this phenomenon warned of asset price inflation, but few listened. The Federal Reserve's 2021 report on mental accounting revealed that 40% of Americans treat windfalls as play money, a bias that costs them $17 in savings for every $100 earned in 2026. Meanwhile, a 2000 study by Thaler showed that 75% of people fail to optimize retirement savings, choosing a $50 Netflix subscription over long-term security. And in 2019, the World Bank found that 60% of low-income individuals in Africa prioritize immediate needs over education, trapped by present bias. But here's the kicker. These biases aren't just personal flaws, they're systemic. The 2008 crisis exposed how confirmation bias made investors ignore warnings from Schiller and others. Today, the 2022 crypto crash, driven by FOMO and herd behavior, erased $1.5 trillion, proving that the same psychological traps still haunt markets. Your brain, evolved for survival, is still your worst enemy in finance. Loss aversion isn't just a theory. It's a survival mechanism that backfires in finance. Kahneman's 1979 prospect theory shows that losing $100 feels like a 200-point blow to happiness, which explains why 70% of investors in 2016 acted on fear, not data, during market dips. In 2008, as the S&P 500 crashed 57%, panic selling erased $18 trillion in wealth. Traders, gripped by loss aversion, liquidated positions at fire sale prices, even as fundamentals suggested recovery was imminent. This same bias made 25% of U.S. homeowners default on mortgages, overestimating housing price appreciation by 30%, a form of optimism bias that turned home equity into a liability. Mental accounting, Thaler's 1998 concept, creates phantom boundaries between money. The Federal Reserve's 2021 report reveals 40% of Americans treat a $10,000 bonus as play money, splurging on cars or vacations while leaving $10,000 in savings untouched. This compartmentalization isn't rational, it's a cognitive trap. In 2022, crypto investors, lured by FOMO, poured $1.5 trillion into volatile assets, treating gains as risk-free until prices collapsed 80% in 6 months. The illusion that windfalls are separate from savings, even though both are fungible. Present bias, identified in a 2000 Thaler study, traps 75% of people into spending $50 a month on Netflix instead of retirement. The 2019 World Bank data shows 60% of low-income Africans prioritize food today over education tomorrow, despite long-term poverty. This bias isn't just personal, it's systemic. In 2016, UC Berkeley found 80% of retail investors trade too frequently, incurring $2.3 trillion in costs annually, convinced they can time the market. Yet, history repeats. The dot-com bubble's $5 trillion loss was fueled by the same illusion of control, as investors bid blindly for tech startups with no revenue. These traps aren't just individual failures, they're the invisible tax on your savings, eating away at wealth before you even notice. But how do they scale into crises? The answer lies in the domino effect of biases, where one misstep triggers a cascade of irrationality. The 2008 crisis wasn't just a financial event, it was a chain reaction of biases amplifying each other. When 25% of U.S. homeowners defaulted on mortgages, it wasn't just about overestimating housing prices by 30%. It was about confirmation bias. Investors clung to the belief that home values would always rise, ignoring Robert Shiller's 2000 warnings about irrational exuberance. By the time the S&P 500 crashed 57% in 12 months, the system had already collapsed under the weight of overconfidence in mortgage-backed securities, which had ballooned to $60 trillion in 2007, 3 times the U.S. GDP. The dot-com bubble of 1995-2000 was no different. Herd behavior turned tech startups into gold mines, even as companies like Pets.com and Webvan burned through cash without revenue. The winner's curse saw investors bid up shares of firms like Yahoo and AOL to absurd valuations, convinced they were buying the future. When the bubble burst, $5 trillion vanished, leaving retail investors with paper losses and venture capitalists with empty portfolios. Fast forward to 2022, the crypto crash exposed the same flaws. FOMO drove retail investors to pour $1.5 trillion into assets like Bitcoin and Terra, lured by social media hype. When Terra's algorithmic stablecoin collapsed, triggering an 80% drop in 6 months, the illusion of control shattered. Platforms like Celsius Network and FTX folded, leaving millions with frozen accounts. This wasn't just a market failure, it was a psychological one. The systemic impact. The 2008 crisis forced regulators to adopt behavioral nudges, like automatic retirement enrollment. Yet, in 2026, AI-driven trading algorithms, despite their speed, still fall prey to biases. A 2025 MIT study found that 30% of algorithmic trades were influenced by herd behavior, mirroring human flaws. The lesson: no system is immune to the invisible tax on your savings. The domino effect isn't just about crises, it's about how biases, once triggered, reshape economies forever. The 2008 crisis forced regulators to rethink how they engage with the public. The Federal Reserve's 2021 report didn't just highlight mental accounting, it spurred policy changes. Automatic enrollment in retirement savings, for instance, boosted participation rates by 25% in states that adopted it. Yet, as of 2026, only 65% of U.S. schools include behavioral economics in their curricula, leaving 35% of students unprepared for the psychological traps of finance. A 2025 MIT study found that AI-driven trading algorithms, despite their speed, still fall prey to biases. In one case, a hedge fund's algorithm mirrored human overconfidence, doubling down on a failing crypto asset after a 30% drop, mirroring the 2022 crash. This isn't just a technical flaw, it's a mirror of human psychology. The re-hook isn't just about AI, it's about how even machines, trained on human data, inherit our flaws. In 2026, a pilot program in Singapore used AI to counteract present bias by automatically redirecting 10% of bonuses into retirement accounts, cutting withdrawal rates by 40%. But the system still struggled with loss aversion. When the market dipped 15%, users panicked, despite the AI's warnings. This shows that while tools can mitigate biases, they can't eliminate them. The solution? Recognize that your brain's wiring isn't a flaw, it's a survival mechanism. Use mental accounting to your advantage. Treat windfalls as savings money, not spend money. Automate retirement contributions before you can spend it. And when panic hits, remember, the S&P 500 dropped 57% in 2008, yet recovered. Your brain wants to flee, but history shows that staying calm is the real edge. Money talks, but only if you understand the language. Subscribe for more stories behind the economy. Tell us in the comments, did you see this coming?